Okay, thank you very much for coming. We are doing another of the series of the webinar series introducing this new launch product, which is the FXStreet Signals Service. I'll be doing this presentation. My name is Gonzalo Moreira. I'm been involved in the project since the beginning with the designs of the strategies, conducting the trading team, and I'll be introducing you to the core concepts in this service. The presentation will be structured in 5 blocks. Each of these 5 blocks will cover a specific aspect of the service, and in between those blocks, you are free to drop questions. Well, you can drop the questions on the chat box anytime, and I'll be answering them as we move on. Okay? Excellent. So let's start with the first block. We have people coming into the room. I see. Perhaps we can just move on to the first block. Okay. On the trading philosophy, there are a few core ideas which are important to explain here, and this is about our trading approach, how we approach markets, how we trade them, how we express them through the signals, through our trade management, through the idea generation that we use here to capture profits in the FX market. Okay, one of the axioms we follow here is to think big and trade small. This is a particular trading philosophy or approach to trading, which is manifested through a use of trades which is different from those approaches where you go all in, all out in one single trade at a time. Instead, what we do is to use many trades. We are usually in the market with lots of trades, and usually we attribute to each of these trades a small amount of volume or a small amount of equity in each of these. So in the end, we are trading the entire portfolio, the entire position, although we may monitor trade by trade, as we shall see in a minute, but we focus a lot on the overall position, on the entire portfolio. And by building a position through different trades, so small trades, we have a better control on the risk management. We have a better control how we escalate in, escalate out of that position, and we have a better control over the fluctuations in the market. When you go all in with one position or a couple of positions or a couple of trades only, you are obviously very tied to the market oscillations, and market can just turn the corner at any moment because of an exogenous information coming in, and you have not much room to adapt to these sudden changes. When you are instead monitoring a big portfolio or a portfolio constructed of many small trades, you can adjust to market changes by dropping trades, by adding fuel to the main direction. You have more flexibility, and thereby your equity does not fluctuate as widely as you would have only one position open or a couple positions. Okay, so that said, we are always in the market. That means there is at any given time there are open positions running, this can go for hours, days, weeks, and even months. Although it's a small part of our trades which go or which remain open for such a long time, from the over 500 or 400, pardon, trades we opened since September, for instance. There are under 10 trades right now which have been open for a couple months or more. This is usually only a small fraction, but in general, we are always in the market with some positions or with some trades open, and we always have a directional bias. We will shall talk more about that. As another differentiation point in this service is the tuition you receive through the Telegram group, where we post our trade ideas, where we explain the rationale, where we monitor the trades and the portfolio, make decisions, anticipate changes in the market, market events, and so on. So all our reasoning is explained. In itself, this is very educative for those which are starting into the trading arena, and also for those who have more experience but are new to this kind of approach, where a combination of technicals and macro is being used to trade. We also cover a lot of basic themes on trading-related subjects. We always try to apply an educational layer on everything we do. So from explaining leverage, margins, how to calculate the peak value, what types of position sizing calculations there are, and so on and so on. We even go into explaining how our strategies work, which kind of setups they can capitalize upon. A lot of stuff that is shared through the Telegram group live with our members, and we also answer their questions. So there is this educational side of the service, which in itself is very valuable. Okay, this was a first block on the trading philosophy. We move on to the systems anatomy. Here it becomes a little bit more interesting. As we said, we are always in the market. For that purpose, we use a multi-strategy approach, multi-pair approach. That said, we only trade FX. We do not trade other asset classes, although we do monitor from equities, bond markets, commodities on a continual basis. And we do also monitor cryptos by itself, but we do not trade or do not execute trades on these assets. We don't have the means to do that right now, the technological means, but we focus a lot on what's happening in related markets from an intermarket perspective. Okay, the way we approach markets using a multi-strategy approach helps us in having strategies for multiple setups for all kinds of situations the market may be staging. That is, we have strategies which capitalize on mean reversions, strategies which capitalize on trend following conditions, on volatility bursts, on breakouts, and even on calendar events. We have a strategy calculating the impact of news releases and trading the most volatile economic calendar events. So there is a huge spectrum of setups which we use, and specific strategies capitalize on each of them. And they apply these strategies to multiple pairs. We do not only trade the majors, or we do not focus on one or a few pairs only, but we execute trades in all kinds of currency combinations, currency crossings. We exploit a lot the fact that lesser known or lesser traded pairs, especially non-dollar pairs, the fact that inefficiencies in these pairs can lead to great trade setups and opportunities. We do exploit them using this multi-strategy approach. So in order to profit from the service, members are encouraged to adopt this multi-pair approach and to use market providers who offer at least the combinations of pairs using the 7 most traded currencies, which gives, in the end effect, it's more or less about, we're talking about 40 something number of pairs, okay? As for the time horizons, obviously by using a multi-strategy approach, we apply also these strategies or these trading logics to different time frames, so that in the end you are profiting from the fractality of the market. You have a strategy, for instance, which is trend following, trying to capture on a trade on a daily chart and on a 1-hour chart, for example. And you may have also strategies running opposite at the same time, because they are capturing different aspects of the price action, of the price series. We shall explain this in more detail in another block. So we use different time horizons, and as a member of the service, you can also adapt to it, or better said, you can take those strategies which fit better in terms of timing to your profile, to your trader profile, to your timings, or you may even choose the strategies which better fit to your profile. That is, if you are more comfortable in using short-term oriented strategies, you may trade only these. You do not necessarily need to trade all the strategies together as we do. Okay. As for the statistical track record, we follow our trade. We have a track record visible in real time at my FX book. Here it is. This is the real account since September last year. Balance and equity displayed here, and below the main numbers such as profitability, number of trades. We are almost reaching 500 trades. As we explained before, these are the open trades, and they're almost from this year. We have one trade from last year only. So here you can see all kinds of the standard statistical numbers which belong to a normal track record. You can follow them here. Okay. And a look inside into our platform. This is the platform we are using. This is a drag and drop type of platform where we are constructing the the platforms not by coding directly, but with the use of a drag and drop type of platform, which allows us to make to build the strategies in form of flow diagrams. They can get as complicated or as complex as we wish. Here you see a complete strategy. Okay, this looks like that, and from this platform, the signal is sent to our servers. It is routed through the trading platform, which we currently have on CTrader. This is the these are the open trades right now, and at the same time, the orders are routed also to the Telegram group and channel, and where the signal is mentioned, trade ID, the direction, pair, and so on. And it's also visible at the signals page. Here it is. Okay, where you see all the open trades and recently closed. Okay, in green for the winners, in red for the losses. Okay, and the currently open trades. They are as soon as the trade is released, the corresponding chip appears on the page and on the Telegram group at the same time as it is executed. Okay, this was the second block. Wonder if there are any questions so far. If not, we can move to the next block, which is about trading. Okay, here we'll tell you a little bit about execution, exits, how we enter and exit trades, how we manage them. The execution is done automatically on our side. The system routes the signal directly to our trading platforms. And on your side, execution is to be done manually. You can pick those signals that you are currently filtering and apply them to your platforms, or you can just choose them all. It is on your side to apply one or the other manner. Every entry signal is mentioned the same way as exits. The exits are from our side executed automatically, and the exit appears as a signal in the chat room at the same time. So the exits are to be done also manually on your side, unless the strategy at the entry signal contains the exits expressed as a stop loss order and a take profit order. In those cases, you can pre-program them on your platform and let the system execute them. But we may apply a discretionary layer on the signals, and we can do it in several ways. We can either apply our discretion to exit a trade before the system does. Okay, we can protect some profits already gained, or we can eventually drop out of a trade before the system does if we see that it's been going too far and we don't want to risk more. So we may exit it manually. We may even, in some cases, it's not the norm, but we may even abort some trades upon execution. That is, the system executes and enters a trade, and immediately we inform our users not to enter this signal because whatever the reason we are giving, be it from a technical view or sustained through any other view, but we may adopt that measure as well, which is not the norm. And another discretionary layer upon the automation is the fact that we can control which strategies are switched on and off at any moment. So before the signal is triggered, we can switch the strategies, the robots on and off, uh, following our own ideas, uh, our technical views, our macro views, our timing windows based on the macro analysis, based on cyclical analysis, based on the larger technical pictures. Okay, so we use a combination of technicals, macro, and cycles for the timing, and this gives us an edge to control a wide array of currencies, a wide array of pairs. Okay, so this much for the trading block. If there are any questions, you are free to drop them here. And we come to the money management. Okay, money management, we have put it here as a separated block because it is essential to any trading and behavior. Money management, as we understand it, is much more than only position sizing. It contains, obviously, position sizing calculations, but it is also about exposure, it's about leverage, the use of hedging, or any technique that serves to manage risk, to manage a portfolio. Okay, by exposure, this may sound as a new concept for many, but by exposure we understand how we are net exposed or directionally exposed accordingly, or in each of the currencies we have open positions. Okay, so for instance, let's jump to the platform here for a moment and see how it can look like. Okay, for instance, we have here on the euro. Okay, we have just closed a euro pound sell order this morning. Okay, and we remain with 1, 2, 3, 4, 5 positions which are euro based. Okay, from these 5 positions, 2 positions are long trades, long euro, and then we have 3 sell euro positions. Okay, that means if the euro is sold across the board, then we make money because we are net exposed. But since we are only 1K net exposed, because these 2 long positions offset the other short positions. So the fluctuations in our euro-based currencies will fluctuate today because we are almost hedged, okay, will fluctuate very little in the overall portfolio, okay? Obviously, these trades have different time windows, time horizons, okay? So they will not close at once. They have been opened at once and they will close in different moments, as we just closed the euro sterling this morning. So the almost 100% hedge we have here will be probably dissolved within the next hours or few days. Okay, so this is what we understand as net exposure. This is something that we inform our users, our members, on a continuous basis, which is the exposure we are having right now, and how that affects the overall portfolio and the evolution of the account's equity. Okay. We also monitor and inform about the effective leverage which is being used in the market. By leverage, it's not only the or not at all the leverage which we can get from a broker or a broker-dealer, but the operational leverage we are using, that is the relationship between our equity, our account, and the volume of all open trades at one moment. That ratio that gives us how much we are leveraged, the gearing we are using in the market at any given moment. Okay, and that leverage, that gearing, gives us an idea how much each pip movement in all the pairs we are in, each pip movement is more or less worth. The more trades we have open, okay, the more money we will make if the market moves in our direction and vice versa. Okay, so if we are sure about the market direction, we are well positioned, we may add to the positions and we may increase the number of open trades and hence our exposure, and thereby each pip will be more valuable and our equity will increase for the better. Okay, in times where the market picture is not at all convincing, we reduce the number of open trades and thereby our effective leverage, reducing also the negative impact which an adverse price movement may have on our account. Okay, and this adding and reducing of positions is done by the smart use of hedging. Okay, and by hedging, we shall not think of a total hedge. Okay, we rarely are 100% hedged in our portfolio. This hasn't happened almost never since we launched the product. But we do use partial hedges, like the one example I've just explained to you. Partly, the hedge results from having different strategies capitalizing upon different setups, opposed setups across several time frames. We may have a strategy going long, targeting a figure for next week or in 2 weeks or in 1 month, but in between we will have reversals, and we may capitalize in the shorter term on those reversals. Okay, this is the idea. Okay, with the use of hedging. So if you want to make a use of our systems, these two things are important: hedging facility and the access to a wide array of currency crosses. These are important. In money management, I would also suggest this. We stress this a lot in our Telegram group: the use of small lot sizes. Okay, there are many broker dealers which offer very small lot sizes or trade sizes of 1K even, and even below 1K. Okay, if you have an account or a starting balance below 1K, you may make use of lots which are below 1K, below 1,000 currency units. Okay, not all brokers have this facility, but you can look for them and calibrate and fine-tune the trades with smaller amounts. Yeah. Because in the end, you are adding positions. In the end, you'll be using leverage as you would use with the same levels as you would go all in with one trade. Okay, but because we are using many trades at once, it is wise to fine-tune the position size. Yeah? And especially if you have a very small account, we do not recommend to trade with trade sizes which are bigger than the start amount. Because from the beginning, by opening the first trade, you are already leveraged. That's okay if you trade just with 1 or 2 trades at once, Yeah, but once you have several trades open at the same time, rapidly your leverage increases. Okay. As for the position size, and this is much tied to what we have been explaining, there are a lot of ways to trade position sizing. This is something that we um, we stress a lot in the room. We use a very simple approach to position size, which is a fixed amount. We trade all trades with using the same position size. Okay, we do not make use of the fixed fractional technique, which is uh, calculating the position size accordingly to a fixed percentage of risk per trade. That is okay if you go all in, all out with a couple positions. It's a position size calculation which comes from uh, trading stocks back in the 90s. It was okay by them, but for the FX arena, it's not always the best use or not the best way to calculate the risk, because um, in our view, it's not the same risking 100 pip or risking 20 pip. By risking 20 pip, your stop is very close to market. If we know what a stop loss order is, it's offering liquidity to the market, so it's an easy prey for the market to touch it and move the other way. So positions which are or orders which are close to the price, especially orders which offer liquidity, uh, like um, like limits and stops, are an easy prey for market forces. Okay, and it's not the same risking 20 pip as 100 pip. So attributing one same percentage of risk to each trade, uh, besides being very complicated if you are trading many positions at once, doing this calculation for all the positions will be complicated. In the end, you may have a result in which you have a positive pip amount, but you are losing money. Okay, so we simplify this. We trade fixed size, and we do monitor the portfolio. Okay, through the exposure, through the leverage. Okay. Fine. As for money management, just one last thing. The use of stop loss orders. You may see in our signal page that not all positions contain exit levels. We are asked often why our positions do not use stops, and our positions, they do use stops and targets, but they are dynamic. They are conditional. That is, the strategy calculates them as it moves along. Let me just explain here. Maybe we can, sorry, if we can see it here on the platform. Let's see this strategy. For example, these are the conditions that must be met for the system to execute a buy order, but then we have strategies or conditions like this one: stop to break even on a buy. Inside this box, we may have another logic which is used to trail the stop. Okay, so many times we don't know the condition, or we don't know the price, the exit price at the moment of the entry, because it's being calculated on the go. And some of the strategies, they have several ways to calculate exits. Here we have the close position box, like we have here. Oops, sorry. Here the close position. As you can see, many arrows follow or lead to the close position. So there are many ways to close the position. Okay, and each of them, okay, take profit. If price comes close to the weekly pivot, plus minus an ATR multiple. Okay, so these are conditional stops. Yeah, and you can't know them at the moment of entry. Okay, but so therefore they are not explained in the signal. They are not mentioned as a price level in the signal. But that doesn't mean the strategy does not know when to exit. Yeah, it's just that it's calculated on a continuous basis. But that should be not a problem if the strategy does not contain the exit levels at the beginning, because we are not using the stop amount to calculate the risk, right? We are using a fixed fraction. We're not using a fixed fraction. We're using a fixed size. So the thing you need to know at any time is the amount of trades you have open and the exposure, and manage the risk there. Obviously, we control each of the single positions. Like, for instance, we are monitoring the euro-dollar right now. It is trapped, or just an hour, a couple of hours ago, this was the situation. It was trapped in this area. We have an open, or several open trades right now. We wanted to capitalize a little bit more in this area, but we may, if the pair turns south here, we may close some of the long trades accordingly to this picture. So we do monitor the trades. We do monitor individual trades, but we also monitor the risk in terms of portfolio, right, by following the evolution of the equity. Okay. You see my colleague has just dropped. Yeah. We have now 8 trades open, and effective leverage is approximately 9-1. Okay. We always recommend to use a leverage 1-1 per trade, so as to have enough available margin to load new positions. Okay. So this is one type of message that we continuously inform, or we may inform on the risk on conditions based on our proprietary or market, in this case, a combination of market indicators. Okay, we have a risk on, risk off indicators, 15 of them, yeah, and we monitor them every day to give an idea how the risk in the market sentiment is, so that we can orient our portfolio, our trades, our bias, and profit from the bigger movements. Okay. Fine. I think there are no questions. If you have, we have reached the end of the presentation. Thanks a lot for attending. I hope to see you in the group. If you are not participating already as a paying member, you are free to come to explore this service. We have on the home page, let me lead you to where the signals, how to reach the signal page. It's on the home page. You can see here a new tab in the menu which contains the signals, and I'm already logged in as a member, but this is what you see as being a member of the service. And here you can join the Telegram group, which is what I've been just showing you. Okay. Okay, thank you. Yes, we will meet again on Thursday, same time, same place. And if you have questions by then, I will be pleased to answer them. Okay. And I wish you a safe trading, a good trading week, and see you by then. Thank you. Bye-bye.